right, market check-in time. We'll talk about what's up with interest rates, inflation trends, and how it's all playing out for you and your clients, all in one quick video. Huge thanks to Don and the Inside Photos team for helping us get this out there. If you haven't touched base with them in a while, it might be a good week to do that. We did start this week with a little optimism, but it just didn't last long. Inflation numbers for April came in mostly tame. Both CPI and PPI were softer than expected, but the market didn't really respond. And it was the third straight month that we've seen inflation move lower, but investors are more focused on whether the Fed will actually do anything about it. And right now that just means more waiting for us. The owner's equivalent rent, which is a made-up number that surveyed homeowners think their homes could rent for, showed up a lot higher again, even though real rent numbers continue to come down. And this is keeping inflation looking hotter on paper than it is in real life, and it's one of the reasons that the Fed hasn't budged. On Thursday, we got PPI revisions and a big misprint from CNBC that showed it was up 0.5% when it was actually down 0.5%. And that error really moved markets before finally getting corrected. And there were also some concerning numbers that we got from industrial production as well as capacity utilization. Both came in lower than expected, which is typically both deflationary and recessionary, which is actually good for mortgage rates. But then Powell spoke and kind of tried to rewrite history. He admitted that the Fed changed its inflation tolerance model back in 2020, pandemic time, and they said they'll probably revisit it again in January. Basically, he was defending the past delays to take action, which they did finally hike way too late. And they said now they're basically risking being too slow to cut rates. But the takeaway is that they're staying restrictive for longer than most economists think they have to. We got retail sales, and it met expectations, but if you factor in the recent rush to beat tariffs, it's probably weaker than it looked. We got jobless claims that didn't really move. But going back to tariffs real quick, even though the US and China did agree to pause most tariffs for 90 days earlier this week, it's being seen as a sign that the economy is not going into a recession, which is actually bad for mortgage rates. Good for the stock market, not great for us. We did wrap up with housing starts and permits this morning. Both came in a little soft. Starts were flat and single-family starts were actually down. Less new construction isn't ideal for inventory, which we're lacking, but it is good for home prices. And builder confidence also dropped a little, although that was before the trade talks that I mentioned did help calm markets a bit. On a positive note, negative GDP news out of Japan actually helped U.S. bonds, which did translate to some slight improvement in rate sheets, almost like a do-over after the rough start to the week. But looking ahead, next week is pretty quiet. We're going to get some housing news and Fed speakers, with markets closing early next Friday for Memorial Day weekend. But have a great weekend, and we'll talk next week.